Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is July 15th, 2018 edition of Market Outlook. So, despite all the cross currents and noise from the fallout of a cantankerous NATO meeting and a meeting with the British Prime Minister, markets seem to love it. So let's take a look at the key indices and what they're telling us here. So this week's action really quite positive. The indices were up and really made some great progress. So as you can see, we're holding nicely above the 50, the 10, and the 200-day moving averages, and they're all accelerating to the upside on the S&P. Now, the other thing where the Dow had been under quite a bit of pressure, really sitting around this or under the 200-day moving average for about a week and a half, we had a pretty decent recovery. Now, in terms of momentum here, our real motion indicators, things are still looking a bit iffy for the Dow. So the other thing to note is our trend strength indicator, the TSI, actually now is in positive territory in all four indices, led by the monster move in the NASDQ 100, which has been led really by about 6 stocks. FANG just has been on fire. And in fact, Amazon hit new all-time highs, trading up around 1,815. That's quite a move in some of those FANG stocks. And that's really been driving the market. But net, you can see here, momentum definitely improving, sort of matching the recent highs. What we certainly don't want to see is a recent failure in terms of momentum, but that does not look like it's in the cards. The other thing to watch as important support on our leading index is the 175 area. That coincides with important pause point over the last week and that 10-day moving average. Also, another thing to note is 275 level in the S&P. That would take out all of this action in here and the 10-day moving average. So this sort of compression range where it looks like we closed, not that far off the all-time highs now in the S&P. Good close on Friday, positive nicely for the week. Now, moving on to the weekly charts and the 4 key indices, I just want to make a note of one thing, which is that the IWM, the Russell, even though it didn't have a great weekly performance, in fact, it was actually down a bit on the week, still on an absolute longer-term basis, looks like the most powerful of all of the indices, especially when you look at our real motion indicator, which is real motion. So even though we got sort of a pause, you can see on Friday we were down a bit, and all the other indices were up. So even with that, overall, the position here in IWM looks really the strongest on a weekly basis when you account for our real motion indicators and pure momentum. On an absolute price basis, it's clearly the Qs, right? We went out to all-time new highs. It's the only index that did it. But one of the concerns here is you can see how momentum, even as we're making new highs, is sort of trailing. So that's often a lead indicator. At the moment, IWM still has good absolute performance and some of the best momentum. Okay, so moving on to some of our risk indicators and intermarket relationships. What is interesting, despite the strength overall in the price movement, the S&P versus utilities, which is an excellent gauge of risk appetite, shows that utilities, even though they were down a bit on the week, actually are still outperforming the S&P. So that's basically a risk-off indication, right? When S&P is outperforming, and this red line here, which is the value of the ratio between the two, moves above the black line, which is the 20-day or monthly moving average. That is telling you risk off is not in play, or markets are definitely favoring risk on. And at this point right now, you can see utilities are still outperforming the S&P. So it's definitely interesting, because here we are putting in a really strong week. The S&P definitely improved. NASDQ on all-time new highs, and yet utilities are indicating some bit of nervousness. So just want to make a note of that. Now, on the positive side, the volume has definitely been improving. There had been a lot of talk about institutional volume and smart money leaving, but from what we're looking at here, you can see you've got now more accumulation days across the board over the last 2 weeks. Now, it's not an all-out buy signal. We really like to see 4 or 5 accumulation days, but the evidence here is you've got a lot more accumulation days than distribution. That's a positive sign and a flip from a couple of weeks ago. Now, the other thing, of course, to note is absolute price movement here. You can see the Dow recovered nicely this week, right? Gaining on those key moving averages, up over 2%. S&P up 1.5%, and again, strong performance by the NASDQ 100. Now, the thing that is interesting to note is domestic U.S. companies, which are in the Russell 2000, took a pause, but net, you can see year to date, the Russells are still up 9.8%, nicely outperforming the Dow and the S&P 500. So there you have it, overall improvement in volume analysis. Now, one thing I do want to note, though, is that the NASDAQ 100, you can see you only had 2 accumulation days and 1 distribution over the last couple weeks. So it's really inconclusive. So it's interesting to note that as this particular index, the NASDAQ 100, hit all-time new highs, the only index to do it, just not on great volume. Also to be noted. Okay, so taking a look at market hotspots, to me the biggest highlight is that volatility has really come off. In fact, it was down 8% over the last 5 days in a bearish phase. So that means that despite all of the news from overseas, tariffs, pressure on NATO, issues with Britain and Brexit, all these type of news events has basically been shrugged off by the US equities market. And I think that is the key theme here, is no matter what, it seems that US equities are on a tear and determined to shrug off any negative news. Okay, that's it for now. Have a great weekend. Hope you're enjoying the summer, and good luck with your trading.